Welcome back, and joining us on the show now is James Anderson. He's senior market analyst at SD Bullion. James, hi, thank you so much for joining in. And the gold prices have been on a one-way run, $700 up in this year and perhaps 1,000 and more up in the last 12 months as well. Now that we are above $33.50 an ounce, where do you see prices heading?
At these points where you start to break out to new all-time highs, it's really hard to gauge in the short, medium term where it could go. You know, I saw Gary Wagner on Kitco News the other night doing a Fibonacci chart, and this is before the recent pop. And he was saying that, you know, with the Fibonacci chart, I posted it on my Twitter handle, he was saying the top likely it could get to 3,500 by the end of May. So, you know, in the interim, you could have a run beyond 3,300, 3,400, up to 3,500 even by the end of next month.
3,500 as soon as at the end of next month. Well, who's buying this gold now, James? Because we've seen jewelry bars in India now kind of hesitant with the kind of volatile high gold prices that we have seen. But do you think that central banks, ETF investments, and that perhaps could continue?
I see it in the derivative market mostly. I think mostly what you're seeing right now is hot money coming in this trade and the momentum side. And you know, obviously, like you mentioned, ETFs and central banks. I mean, it has to be known and driven home. Most people don't understand that pretty much since 2022, 2023, 2024, central banks, especially emerging market central banks, have been buying gold at record volume. I mean, you can go back to World War II. We've never seen this amount of official gold bullion tonnage being purchased by central banks. What it reflects is a bullion over bonds trade, and that is a phase transition. That is something that's not just happening in the short run. That's something that's likely happening on the long run, where central banks are moving back toward the old allocation of having 30, 40% of their liquid sovereign wealth in outright gold bullion reserves. So that's on a longer term scale. I think people have to kind of adjust their minds to understanding that we're going back toward the old money, which is gold being the numeraire that matters most.
Oh, well, absolutely. But James, every bull run has a correction, and gold hasn't done that for a while now, while the momentum still is on the higher side. Do you see gold at some point in time get a correction, even a healthy one?
Yeah, every bull market, every one of them has to climb a wall of worry. Okay, so 3,500, if it goes there, say, at the end of May, and it recedes and it goes back and retests 3,000 or goes below 3,000, you have a 200-day moving average of gold that's at 2,700 roughly and rising. Okay, so it is possible that you could have an interim top where it goes toward that 3,500 number and then crashes back down over the North American summer, where it dips again below 3,000, because those levels, 1,000, 2,000, 3,000 for gold, they are always a wrestling match. They don't usually happen. We've already had one break above it, one test below it. And I think ultimately we may get one more test below it when it's all said and done. And that's my hunch, is that this summer we'll see that one more test below. And it's very common in a bullion bull market for gold to retest its 200-day moving average. But the thing is once it's done that, generally silver goes nuts. So that's the other thing that we can discuss.
Well, I was coming to silver really, and we have seen silver kind of underperform gold in last year and in this year as well. Where do you now see silver prices by the end of 2025?
So I think the general bullish consensus in the global, silver analysts, it's basically 38 to 42 has been more or less the general consensus for the year in terms of, silver's high, $38 an ounce, $42 an ounce, somewhere in that area. There's other people out there who think it could go higher and faster and retest that old ancient nominal high of 50 an ounce from 2011 and 1980. What it does by the end of the year, it's not really so concerning to me, because I see this more as a long-term trade. I'm holding bullion through this decade into next, because ultimately I see the gold-silver ratio crashing back down toward where it went in 2011. I worked, traded, invested through 2011's silver and gold bull market. This bull market that we're in blows that away. That bull market was a pipsqueak joke compared to where we're going in this one. And so ultimately, when I look out, I think in terms of 5-10 year timeframes. I don't think in terms of a 1 year trade. So if someone is going to get in this market to speculate, well, good luck, because silver is absolutely volatile, and you're going to get your head handed to you occasionally in the silver market. It's one of the more volatile and dangerous markets to be trading on a short term basis. But on a longer term basis, if you do the study and you do the work, and you understand kind of ratios and take the fiat currency out of the equation and use long-term ratios of silver and gold versus the S&P 500, say, or silver and gold versus, you can use bonds, you can use real estate, you can use monetary base, you can use a whole bunch of variations to kind of take out the noise of the fiat currencies as they start to devalue further and further to bullion.
Well, James, as you said, that the gold and silver prices are reacting to a lot of things. As of now, for gold, it really seems like a safe haven and a hedge against various things that are happening in the international markets. What is it that you would want to watch out from here on in sense of fundamentals? I mean, tariffs is one thing, geopolitics another, the fiat currency is the third thing. And then, of course, it also is about interest rate cuts, global central banks buying. Where do you have your focus on?
So the biggest thing for me as a United States citizen is knowing that we have the largest debt in the world of all time in terms of nominal terms. And our debt to GDP is almost at the level where Great Britain was after World War II, after the war. In order for them to get out of that, they had to basically debase the pound. And ultimately, I think that's where we're headed in the United States. We have to devalue the dollar in order to meet nominally the obligations that we've made. We have 36 trillion in debt. We have a deficit this year that's probably going to be over 2 trillion. It's on its way. It's even larger than last year. We have a situation of unfunded liabilities that we have to pay on in terms of Social Security, Medicare, Medicaid, et cetera. That's depending on who you talk to, a net present value looking out of over 100 trillion to 200 trillion. It's just unpayable sums, right? And so what are the options that generally happen in history for countries and empires that are kind of fading, going from a unipolar world to a more multipolar world? Well, generally what they do is they don't default, they just devalue the currency. And so as time goes along, the world is going to realize that the dollar is no longer as good as gold. It hasn't been as good as gold for a long time, but it's going to become painfully obvious that that is the case. And all of a sudden, you're going to get a mania in precious metals, gold, silver, and even platinum later on.
All right, James, thank you so much for joining us today. Manisha, thank you for joining in as well.
Thus far in this 21st century, gold bullion has outperformed dividend reinvested stocks in the USA by more than double, or 2x the latter's performance. In the last near 25 years, even silver bullion is now beating stonks with dividends reinvested. The financial media was out this week pointing fingers as to why gold has been outperforming virtually any and all other asset classes so sharply of late. Fingers are being pointed at seemingly insatiable Chinese and Indian gold demand ongoing. Bank of America published a recent survey of fund managers citing gold as being the most crowded long trade at the moment. As the bubble of the overvalued Mag 7 has been losing ground to gold since the start of 2025, fingers have also been pointed at China for why the U.S. Treasury's 30-year bond yield soared by the most it has in the last 40 years, even as the U.S. stock market tumbled. Now, historically, the 60-40 portfolio was always set up to allow bonds to perform when stocks were not. Now, neither is performing. It's called a secular bear market for both simultaneously. 80 billion of funds have flowed into gold proxies thus far in the year, dwarfing the COVID 2020 ramp. Yet when we compare Western investors' unsecured gold ETF allocations versus all ETF allocations outstanding, and gold miner ETF allocations versus all ETF allocations, it remains clear that gold is a fractionally tinier trade currently compared to where it was back during the 2011 run to over 1,900 an ounce. Currently, gold in the Western world derivative proxies is about half of where it went during the 2011 highs. Goldman Sachs is now re-rating possible runs for gold this year, aimed as high not only at 4,000 an ounce, but possibly beyond. Again, pointing fingers at China and their insurance companies moving into the gold market has been a handy recent scapegoat as to why this is currently happening. Stock, bond, and crypto cheerleaders on CNBC have been left to stammer through this while it's happening.
Check out the price of gold at $3,200 and today giving about 0.5% back, but just been on an endless climb this year. But Goldman just raised its year-end forecast to $3,700 an ounce from $3,000, with a projected range of $3,650 to $3,950. And the note said gold could potentially hit $4,500 by year-end in an extreme risk scenario. They see stronger than expected demand from central banks continuing, ETF fund inflows due to recession risks. I don't know if people have demonstrated exactly that.
The truth of this recent Western inflow into unsecured gold ETFs is actually tiny compared to the outflows we saw post-COVID 2020. The gap between the gold spot price rising and unsecured Western ETF investor inflows, having been front-ran now well behind the trade, is clear right here for all to see. Meanwhile, government central bank gold buying in record size is likely continuing as the bond bear market sells off, emerging markets move to de-dollarize further, and foreign investors begin to sell underperforming U.S. assets and move their capital back towards reinvesting closer to home. And while Goldman Sachs' desk starts to sound like a YouTube gold price pumper channel, I want to end this opening salvo by reminding you that at some point not long from now, gold will experience a reversion back toward its long-term moving averages. The steeper that occurs, the more likely in the eventual rebound that silver will join the party too, finally. There are already Bloomberg terminal notes being passed around, reminding fund managers of how silver has historically outperformed even gold bullion bull markets in white-hot flashes of price multifoldings, citing the 1979 to 1980 10x move in silver as a phenomenon to stay aware of possibly rhyming in time. Now stick around. After this short break, we'll run through a few charts examining gold and silver around the world and the potential performance to come.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway. The spot silver and gold markets traded slightly up on this Easter holiday shortened week. The spot silver price closed at $32.60 an ounce bid, and the spot gold price finished at $3,326 an ounce bid on the week. The spot gold-silver ratio climbed on gold's relative strength over silver, finishing the week still in rarefied triple-digit air, closing at 102. Silver industry spokesbody, the Silver Institute, made headlines this week, publishing data showing a further structural global silver market deficit of negative 148.9 million ounces in 2024. With industrial demand for silver skyrocketing over the last 5 years especially for high-tech applications, the industry now citing a combined silver demand outstripping ongoing supplies to the deficit tune of negative 678 million ounces since 2021 through last year. That deficit is equivalent to 10 months of global mine supply in 2024 alone. Mexico, Peru, China, and other nations around the world will continue to have to pump out new line silver supplies at these still depressed silver price points, as growing silver industrial and likely coming investment demand shows low to near no signs of waning. Even as gold continues regularly hitting new nominal record high price points in over 160 fiat currency numerators worldwide, silver has been relatively quiet for now. Silver's recent spike dive down in price has certainly helped cool off bullish sentiment, while the same cannot be said for gold thus far in the year. A quick look at gold and silver around the world, and we'll start with gold and silver in the former dominant reserve currency empire of the world, the United Kingdom, where gold has obviously broken out, and now it's also being sold to retail investors at Costco, whereas silver in fiat pounds is closing in on its 2011 nominal price high. It's possible later this year that we see it break out beyond. On the Indian side of the gold-silver equation, if gold simply stopped rising and silver simply matched its breakout performance to date, silver in fiat rupees in India would have to double from where it is right now. And yeah, I sent this chart to CNBC India's Manisha Gupta. Gold breakout in Switzerland has yet to be joined by silver, as it still requires silver to nearly triple in spot price currently to reach its old 1980 nominal price high still. Gold in Sydney, Australia's deflating real estate bubble, has turned below its 2011 lows, and is now on course, likely back toward its 1980 lows in time. Silver eventually follows. And here's a 21st century reminder for gold and silver bullion bulls in the USA of past underperformance gaps, of gold outperforming silver until eventually silver explodes and outperforms gold akin to 2006, 2008, 2010, and 2011 silver price high spikes. Now, getting silver bullion this relatively cheap versus gold bullion at the moment should eventually prove to be superb value later on. And given that we currently have a bifurcated silver price discovery market where silver seemingly always goes up during Eastern trading hours and gets derivative short smashed during Western trading hours, understandably, silver bullion bull patience is again growing thin. Hang in there. We have been doing similar systemic gold price suppression attempts in the much larger, harder to control global gold price discovery market since COMEX gold futures were invented in 1975. And as you can see, the red gold spot price line climbing walls of late, gold price suppression by short side derivatives have not been all that effective of late. In time, I will be able to show and tell you the same phenomenon for silver as fake price discovery finally gives way to silver doing something akin to what that Bloomberg terminal note warned readers of potentially repeating. Silver multifolding in not merely prices, but most importantly in relative value versus almost all goods, services, and asset classes worldwide. A happy Easter to you and yours who celebrate the resurrection of Christ. That will be all for this week's SD Bullion Market Update, and as always, take great care of yourselves and those you love.
If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.